Good day, my name is Dean Crocker. I'm a research analyst with the PSG Wealth team. Today I'll be taking you through our latest year report completed of Bank of America. So on the 14th of July 2021, Bank of America released its second quarter results for the full year 21. The period was really dictated by lower yield curves. 10-year Treasury bond has been similar to around about 1.2%, fluctuating up to maximum about 1.5, 1.7%. It's really lower yield curves. But the group, and in line with a lot of the peers within the banking sector, has seen a significant release in their provisions, which has bolstered their results. So in terms of the second quarter results, the business, once you strip away the once-off benefits of their improvement in terms of the positive tax adjustment and the credit loss provisions, the pre-tax or the pre-provision profit was actually lower quarter on quarter. So it did seem as if there was a weak underlying performance. In terms of the provision release, there was a net 1.6 billion credit loss provision release. And the reason for this is really just citing stronger economic conditions within the US, and this allowed them to be a bit more or less conservative in nature and release some of the provision build-up that they had. In terms of the positive tax adjustment, there was a deferred tax adjustment for the UK deferred tax assets, and the valuation resulted in a positive tax adjustment supporting the headline earnings. Pleasingly, and in line with pretty much the entire banking sector of the US, they have proposed an increase in the quarterly dividend from the third quarter 2021, and we'll talk about that very shortly. In terms of our recommendation, we have maintained it at neutral. The valuation on a price to book value is roughly about 28% premium to its 5-year average of 1.3 times, and it is, however, in line with its peers in terms of their valuations, which is at 1.3 times. This is also on the back of a lower treasury yield, but however was supported by those credit loss provisions. In terms of the valuation, it would appear that the share price had factored in a significant rebound in economic activity, which has been seen in the US, and the share price seems to have run beyond its valuation. Thus, it does seem, and to us, does appear to be fairly valued, hence the neutral recommendation. So just in terms of the event, net revenue came just under expectations. It was lower on the quarter-on-quarter basis, so it did miss expectations. The net interest income, however, did beat expectations quite pleasingly. At present, and I think the story in a lot of the banking sector in the US is that the net interest margins and the contribution from net interest to the revenue or to the bottom line has really deteriorated or become quite small in stature. At the moment, it's about a 50-50 split between the net interest income and the non-interest income. In terms of the credit provision release, so you can see there's a negative 1.6, which implies that there was a release relative to a larger release in the first quarter, so there was a bit of a deviation there. The ultimate impact of this, as well as the benefit from that taxation release and the revaluation of it, resulted in net income actually increasing on a quarter-to-quarter basis. However, as I mentioned, if you strip out all those once-off events, it actually missed in terms of its second quarter versus first quarter. Earnings per share were above $1 per share, whilst the dividends per share of 0.18 is currently what they have. Their revised target, if I remember correctly, was 0.23 from the third quarter onwards. What is interesting to note, and it's something that we've seen across the US industry, is they have a significant amount, and they always talk about it, they have a significant amount of excess liquidity within the market. They've had a big growth in terms of their deposits, and their loans have actually been a bit staggered in terms to maintain or keep up with that deposit growth. It would also be that the US banks might have been a bit more conservative in nature, and particularly given COVID, it's well justified not to expose themselves to too great a credit risk. You can also see this in their CET1 ratios and the various capital adequacy ratios, that the banks are actually well capitalized and they maintained a lot of their liquidity to prevent any risk or on-balance sheet risk. Nice to see, however, that the net loans and advances are starting to grow. Remember, the Bank of America is really consumer-faced more than some of the other banks, so this does show some good consumer growth. In terms of book value per share, that's up by 2.8% to $29.89. That did beat expectations, which is a good thing. So in terms of the impact on the date of release, the results were not really received that favorably. They closed down 1.9% relative to the Dow Jones, which was slightly higher. In terms of their performance since our last recommendation, we gave a neutral recommendation in April 2021. I think that was on the back of their first quarter results. They have underperformed the benchmark by 4.67%. However, the year-to-date return is still about 16%. In terms of the price momentum, you can just see on the graph on the right-hand side, we have two bands. Effectively, they talk to the same metrics. But on a 50-day and a 24-day moving averages, you can see that it's actually negative, implying that there's a bit of sell-off coming through the market in terms of their price momentum. So the assessment, Bank of America, it really does remain our preferred consumer banking counter. They've demonstrated historically very strong growth. They have improved their credit quality, and you can also see that the provisions are going to release to such a level that they're actually coming back to about a pre-COVID level, implying that there's a bit of a normalisation in those numbers, which is a good thing in terms of valuation because it gives a bit more stability in their numbers. They also have reported, and you can see this in the JP Morgan report which will follow this, they also reported strong credit card growth, which is very good for them. In terms of the macroeconomic conditions within the US, there's a lot of talks around the inflation. And there's also, the Fed is obviously talking a lot about the easing of liquidity within the market. This all supports an increase in treasury yield. At the moment, treasury yields 10-year, I think as of today, about 1.3% relative to inflation in the market, which is roughly between 4 and 5%, implying a negative yield. So our thesis is, the treasury yields are low at the moment. The bond market is remaining very low. But at some point, we do expect to see a yield curve starting to increase. And I think the market as in general and a whole did have that same expectation, which is why the financial sector actually ran so hard in the beginning of the period, and which is why those valuations looked a bit stretched at the moment. In terms of the greater market, they all talk about excess liquidity. It seems like, the bank repurchase programs and the quantitative easing, which the US has undertaken for a number of years now, has really resulted in a market with a significant amount of excess liquidity. This is great in terms of risk, but it also is difficult in order for the banks to try and generate yields or returns from the excess liquidity. They can only invest so much into loans, and thus, their risk matrix within their own balance sheet also come into play. This has resulted in them investing a lot of the money into fixed income, more into banking, lending. So a lot of their balance sheets actually look a bit lazy in that sense. They haven't seen significant uptake in the riskier assets, which generate a higher margin. And right now, given that the rates are so low in terms of treasury yields, it's justifiably so that why would you place your money at a greater risk? This has been a bigger concern, but there's a lot of talks now from the Fed of reducing the quantitative easing within the market, which should spur on the rates going a bit higher. It will probably make the balance sheets start having to work a bit harder. So just in terms of valuation, I have touched on it previously, they are trading in line with their peers and a slight premium to the 5-year average. And off the back of everything, it does seem like they're fairly priced. It does seem like the market priced in the stronger economic conditions of the US and a rise in yield curve. But over the last few months or month or so, we've seen a bit of a staggering in terms of a re-rating of the share prices, and they've come off a bit. And overall, it would appear that these banks do look fairly priced right now. One thing that we are concerned about, we do believe it's priced in to a certain extent, is the re-rating of the yield curves. But should the yield curves re-rate faster, that is definitely a risk to our valuation and our current call. And if we do start to see, 10-year rates, we usually look at about 10 in the 2-month or 3-month variable. If that starts to rate up above your 2.5%, then we might see an increase in these share prices. If you'd like to place a trade, please speak to either your financial advisor or the trading desk. Thank you.